Let's take a look at the Rand and what exactly it's up to, because we saw some strength managing to filter through yesterday and now weakness setting in.
Morning, Alishia. Yes, the Rand did strengthen yesterday. We saw a lot of the volatility in financial markets that occurred last week seems to have dissipated at the moment, and a bit of risk on has come back into the market. So the Rand did benefit from that. And should the situation prevail, we'd be looking to see it make a break, perhaps towards the 696 level. But as you mentioned, there's also the possibility of extended Rand weakness. It might also be looking a bit weaker this morning. And even at the moment focused on data out of the EU and US later out today. So if that data cut proves to be disappointing, we could have a focus once again turned on global growth prognosis, and should investors prove to be disappointed by that, then we could see risk aversion spiking once again, and then of course the Rand could head back the other way, perhaps as far as 722, 723.
Of course, that risk on button being pushed on account of all that's playing out in the developed world economies. And what's interesting is that the markets locally have shrugged off some of the wage strike action we've been seeing, and the intensifying labor strife that persists in the country. Is it just a case of too much else happening in the world and the markets having too much else to focus on right now?
I think it absolutely is, Alishia, and particularly you see that in the Rand, because it's being driven mostly by international developments and of course investors' perception or attitude towards risk as it changes from moment to moment. So I think there's just too much going on in the world at the moment for investors to be worried about issues like the municipal strike. Although interestingly, it does seem that the strike in Gauteng, which is the economic center of South Africa, didn't go off quite as planned and was far more muted than people had expected. So that could also have been a factor that played into the fact that people don't seem to be concerned about that too much at the moment.
I ask because Finance Minister Pravin Gordhan yesterday reiterating that disciplined fiscal policies have helped South Africa weather the turmoil in the global economy. And at the moment, the country, despite all these woes that we may have, has a lot rosier picture that it presents compared to developed markets. And that's holding us on good ground. What have you read into that commentary that's hit the markets?
Well, those are certainly comments that he has expressed before and certainly have proven to be true. South Africa did weather the global financial meltdown 2008-2009 relatively well when compared to other countries, and growth has recently been picking up, although now seems to be entering a bit of a soft patch. So certainly nothing unexpected or untoward in the comments that he made yesterday, and certainly one would expect, as he indicated, at the moment emerging markets are looking particularly strong as a whole. Their fiscal balances, which is a topical issue at the moment, seem to be well under control. Although inflation is rising through most emerging markets, we've seen central banks ready to tackle this threat. So on the whole, emerging market economies are looking very good and growing quite strongly, and that's in contrast to what we're seeing in most of the developed economies at this point.
Of course, we've got sovereign debt concerns that remain and persist for the euro, and that's a currency to which we're highly correlated. We've got the EU's latest attempt at, of course, delivering a comprehensive solution to the region's vulnerabilities, disappointing so far. What are your expectations out of today's meeting in Paris?
Well, no firm expectations out of today's meeting. Of course, what one would be hoping for is to get a firm, concrete and final solution to this problem that has been going on actually for a number of years in the Eurozone. And every time it seems that once the country at the center of the current crisis, once that is resolved, then attention then shifts to other economies in the Euro area. So clearly what one would be looking for is a solution that is going to put the matter to rest once and for all. But we're not optimistic that this meeting is going to result in that final outcome. We think that the situation is likely to get much worse before policymakers finally come to decisions such as creating a single Eurozone bond market. So in the short term, we'd still be looking for the situation to continue to bubble under. We still see the euro under pressure, sinking as far as 120 against the dollar, but then coming back once some sort of resolution is reached, hopefully towards the end of this year.